We are taking up today liability insurance. Liability insurance. So, better to understand first. Liability insurance is one segment of general insurance which is having number of policies under this section. The most important thing is what is liability in fact. So in insurance parlance, the liability means the responsibility one person has towards another in the society. Means every person is responsible for the one another. You are responsible for me, I am responsible for you. We should not infringe our personal rights. We should not cause nuisance. We should not injure or cause bodily harm or property damage to anyone. These are the responsibilities of a person. So how the responsibility arises? By virtue of law or statutes, means act. The Public Liability Act 1991 is there. Rights demand responsibilities too. If I have got a right, you also have got a right. So when there are rights, there are responsibilities also. Awareness about rights. People who are aware of law, people who are knowledgeable about the law, people who are concerned anyhow with the LLB or the practices, they have more awareness about their rights. So as the society progresses, litigation increases. This is something very important to understand. Because as this society progresses, means when there is a literate people in the society, they are obviously cautious about their rights and responsibilities. So when any of their right is infringed, they will prefer to file a suit against the person who is causing any sort of loss or damage to their body and property. So this is something called liability, which arises by virtue of law. Rights demand responsibilities, and there has to be awareness about their rights. As the society progresses, litigation increases. Now the question is, what is legal liability? When the legal, what is added to the responsibilities, it becomes legal responsibility. Means the legal responsibility is to pay for the damages resulted. Damages may be financial or in any other way. So that is the legal responsibility as per the law of the land. Now basically, what are the core ingredients of the liability? There has to be a mistake or negligence or inappropriate action on the part of one person. Mistake, it may be by virtue of negligence or by inappropriate action. Then because of that, there must be some loss. And this loss may be a bodily injury, a property damage, or a financial loss. Then a third party claim for that loss within the policy period. Third party claim may be with the insurance company or with the court of law. Because the compensation is required for the loss caused to any person by way of mistake, and this loss may be in the shape of bodily injury, property damage, or financial loss during the policy period. So this is called legal liability. Now under the liability segment you will find number of policies. Number of policies. But all these policies are divided into two basic categories. One is casualty lines and the other one is financial lines. As far as casualty lines are concerned, Under this group, those policies are included which are directly concerned with the third party bodily injury and property damage claims. I repeat, under the casualty lines, only those policies are included which are directly resulting into the bodily injury or property damage claims. These policies could be public liability industrial, public liability non-industrial, commercial general liability or better known as the CGL policy, and product liability. They are the policies which are directly causing the bodily injury or the property damage to the third person. Then there is other segment which is called financial lines. Under this category, those policies are included which are directly resulting into the financial losses. Financial losses to any third person. That may be due to the negligence or by inappropriate action. How these are caused? By the negligence or by inappropriate action or by mistake, you can say. So these are the policies which include professional indemnity for doctors, professional indemnity for hospitals, directors and officers policies, cyber crime policy. These are the policies directly resulting into the financial losses to the third person. So this classification of liability segment is based on two categories only, casualty lines and financial lines. Casualty lines includes those policies which are directly resulting into bodily injury and property damage, while the financial line policies are directly resulting into the financial lines to the third persons. Now let us see the basics of liability insurance and concept. So the concept of AOA and AOY is prevailing in all the liability insurance policies. In other words, we can say if the insured had to select the limit of liability or limit of indemnity or sum insured, he had to select AOA and AOY. Now what is AOA and AOY? AOA stands for any one accident and AOY stands for any 1 year. Both the limits have to be selected by the insured. There is no compulsion at all. There is no basis at all. This is the choice of the insured to select AOA and AOY. AOA is the maximum. AOY is the maximum liability of the insurer for all claims arising out of all accident during the policy period. Means in AOY, whatever number of claims are taking place in an year, so that maximum liability of the insurer will decide that amount, but the limit selected by the insured will not be exceeded. The maximum limit is selected by the insured himself. While AOA, that is any one accident, that stands for each occurrence or per claim limit. Means in one accident, the maximum liability of the insurer could be what? In one accident, the maximum liability of the insurer for all claims arising out of a single accident would be considered under the AOA. Now the question is, the prevailing ratios are only 4. For all the general insurance companies of India, almost the terms, conditions, wording, clauses of the policies are same, though this is not the tariff segment. But the practice is same, and the prevailing ratios gives you 4 options. 1 is equal to 1, 1 is equal to 2, 1 is equal to 3, and 1 is equal to 4. Means insured have to select the AOA and AOY out of these four only. Now what these four are? These ratios represents amounts, not number of times of accidents. These ratios represents amounts and not number of times of accidents. So amount should be in the ratio of 1 is equal to 1, 1 is equal to 2, 1 is equal to 3, or 1 is equal to 4. Out of these four, any of the ratio can be selected by the insured to decide both the limits of AOA and AOY. How this is? See an example. AOA and AOY. Insured has selected 1 is equal to 2 ratio. Insured has selected 1 is equal to 2. And the AOA selected by him is INR 50 lakhs. INR means Indian National Rupees 50 lakhs. So the AOA means annual accident limit. If the annual accident limit is 50 lakh rupees, selected ratio is 1 is equal to 2, that means annual year limit would be automatically INR 100 lakhs or 1 crore rupees. Means 50 lakh is equal to 1 crore. This is called 1 is equal to 2. Now what would happen suppose this ratio is selected? I give you 3 examples, 3 different examples, which will explain how this ratio will work. Clearly, you can understand with these 3 examples. See, the first situation is AOY is 1 is equal to 2. Amount is 50 lakh is equal to 1 crore. This is the limit selected by the insured. Now, under the policy, in first situation, suppose 3 claims of INR 30 lakh each are reported to the insurance company. 3 claims in one policy year, each claim of 30 lakh rupees. What would be the situation if AOA and AOY is 1 is equal to 2 and the amount selected is 50 lakh is equal to 1 crore? So under the first situation, insurance company will pay all claims of 30 lakhs. Why? Because 30 lakh rupees is not more than the AOA limit. AOA limit is 50 lakh. And the total 90 lakh rupees is not more than the 1 crore rupees. AOY limit is 1 crore. So all 3 claims are within the AOA and AOY limit. That means all 3 claims will be settled subject to policy directives. Situation 1 is clear. Coming to situation 2. 4 claims of INR 30 lakh each are reported during the policy year. 4 claims of 30 lakh rupees each are reported during the one policy year. And each claim is of 30 lakhs. That means 3 claims are fully payable. 30, 30, 30. Total 90. Subject to deductibles of the policy. But the 4th claim is not payable because the remaining sum insured is only 10 lakh rupees. While the claim amount is 30 lakh rupees. So the 4th claim would be paid only for 10 lakh rupees or the remaining sum insured. Or you can say until the AOY limit exhausts. It may be 10 lakh, 11 lakh, 12 lakh because the policy deductibles are also there. But not complete 30 lakh rupees because the sum insured exhausted. Any 1 year limit is exhausted, finished. consumed, you can say. Now coming to situation 3. Situation 3 says only one claim of 75 lakh rupees reported during the policy period. Only one claim of 75 lakh. Now what is the situation? For one accident, the maximum limit is 50 lakh rupees only. So the claim is payable only to the limit of rupees 50 lakh rupees, subject to policy deductibles. Claim will be paid, definitely, but not for the full amount because it is exceeding the maximum limit of AOA. Maximum limit of AOA is only 50 lakh rupees. So this claim will be settled for 50 lakh rupees only. So this is the way how the AOA and AOY works. Now what is the policy deductible? Suppose the claim amount is 50 lakh rupees. And on the policy itself it is written that the compulsory deductible is 10 lakh rupees. So when the claim of 50 lakh rupees is settled, policy deductible of 10 lakh rupees will be reduced. So the total payable amount would be 40 lakh only. This is called policy deductibles. Another important terminology of liability insurance is territory. Territory means what? Geographical region within which the claim incident must occur. And normally this geographical region is Indian territory, within India. Then comes jurisdiction. What does jurisdiction mean? Geographical region where a claim can be filed in the court of law. So if the geographical territory is within India, in that case jurisdiction will also be within India. But this is as per the choice of the insured. This can be extended. The insurance company can extend the jurisdiction also and territory also. Because the options available for territory and jurisdiction are: first, India; second, worldwide, though we do not prefer it, but worldwide option is already there; and third, worldwide excluding USA and Canada. The coverage is for worldwide, but the claim filed within the court of US and Canada will not be paid. So these three options are available: within India, worldwide, and worldwide but excluding US and Canada. Now see the example how this will behave. Say for example, a tourist comes to India and a claim incident occurs here. Later he goes back to USA and files a claim against the insured in USA. Means a person came to India. Suppose I hit him, I caused him bodily injury. I have the policy, public liability policy. He came to know. He did nothing when he was in India. But the moment he returned to USA, he filed a claim against me. Now what will be the situation? Suppose the territory selected is India. Insurance company has provided only the Indian territory. And jurisdiction also provided is India only. In that case, whatever amount is settled by the USA court, this policy will not pay any claim. Situation second. Territory given is worldwide. Jurisdiction is also given worldwide. In that case, the full claim is payable whatever is decided by the US state court. Third. Territory given is India, but the jurisdiction given is worldwide. Means the incident took place in India, but the case is filed in the USA court. That means the worldwide jurisdiction allowed to pay the claim whatever is decided by the USA court. So claim will be settled. Under the fourth situation, where the territory given is India, but the option given is worldwide excluding USA and Canada, and the court case is filed before the USA court, USA and Canada are excluded. That means this policy will not pay any claim. So that is how the policy will behave when the territory and jurisdiction are opted by the insured. If they are within India only, the liability of India only payable. Under both the situations, territory and jurisdiction. But if they are worldwide, the coverage is wide open. If they are excluding US and Canada, except those countries, the liability will be payable. Now other factors, say insurance period. So in a liability policy, insurance period means period from policy inception date of the first policy to policy expiry date of the current policy, provided the coverage is uninterrupted. Means as usual, but not for 12 months. If we are thinking this is for 12 months, that is called policy period. Policy period means period from policy inception date to the policy expiry date. This is called policy period, 12 months or 1 year, because the policy is issued for 1 year only. This policy period is different to the insurance period. Insurance period means period from the policy inception date of the first policy, not of the current policy. Maybe I am continuing the policy since last 3 years. So my insurance period starts from the inception date of the first policy to the expiry date of the current policy, provided the coverage is uninterrupted, means there is no break, continuation. The policy is renewed in continuation. Then there comes an interesting term that is called retroactive date. Now what is this retroactive date? This means the date at which the insured took the policy for the first time and has been continuously covered. This is also the beginning date of the insurance period in the claim made history. So retroactive date starts from the first date of the first policy. It continues till the policy continues. And there may be extension, extended reporting period or discovery period. In case the cover is discontinued, the insured can report claims arising from the acts committed within the policy period and within the extended reporting period. Say for example, ABC Limited has been buying policy incepting January 1 to 2010. First policy they have taken January 1st, 2010. For last 3 years, without a break, with the extended reporting period of 30 days. Now his policy expires on December 31st, 2010. He does not buy a policy thereafter. A claim is reported on January 15. Policy expired on December 31st, 2010. Claim is reported on January 15, 2011. This is also covered. Why? Because the policy provides extended reporting period of 30 days. So since the policy has a 30 days extended reporting period, the claim is paid. So that is how the policy period, insurance period, retroactive date and extended reporting period are treated under the liability segment. This is also one example. See, policy period is current policy period, but retro period is previous policy period. If both are clubbed together, it becomes insurance period. It also has the discovery period or the extended period. So insurance period is a wider term as compared to policy period. Now there are two methods of settling the claims under the liability segment. One is claim made and reported. Claim made means we have to understand these dates. Claim made policy means loss occurring during the period of insurance, but claim being first made during policy period are covered. Say how? Loss occurred on May 5, 2009. Claim first reported on May 10, 2010. Retroactive date January 1, 2009 means policy first given was January 1, 2009 to 31st December 2009. Then it was renewed on January 1, 2010 to 31st December 2010. So the loss occurred in first policy, May 5, 2009. But the claim was reported on the second policy period, May 10, 2010. So it was on the policy period only. So since it is in continuation, the period of insurance cover this liability and the claim will be paid, settled. So this is known as claim made and reported. Another version is occurrence based. Occurrence based policy means loss occurring during the policy period. Claims reported within the policy period or thereafter, any time in future are covered. Means here the liability of insurance period is not covered. Only policy period is covered. Say suppose loss occurred on May 5, 2010. But claim reported on May 10, 2011 means after expiry of that. Policy first started from January 1, 2010 and expired on December 31st, 2010. This is policy period. Remaining future period is extended period. So if it is reported within the extended period, then the risk is covered under the policy period. So here the policy period is important, and in claim made basis, period of insurance is important. Now see what policies we are having under the liability segment. Professional indemnity insurance for doctors, errors and omissions for medical establishment, professional indemnity insurance for engineers, architects, interior decorators, chartered accountants, financial accountants, management consultants, lawyers, advocates, solicitors and counsels. This is professional indemnity policy. Then Public Liability Insurance Act only, Public Liability Insurance Industrial, Public Liability Insurance Non-Industrial, Product Liability, Commercial General Liability, Employer's Liability or Workman Compensation, and Carrier's Legal Liability. Now you may be confused what is this C and F. So this F stands for financial lines, C stands for casual lines. In casual lines, the compensation is paid for bodily injury and property damage. In financial lines, the compensation is paid for the financial losses. So see how the liability is settled. Maybe you are having a liability policy, but it is not guaranteed that the claim is paid under that policy only. Because products are different. Say suppose product defect is there. Accident due to a faulty tire killing the driver. Accident due to a faulty tire killed the driver. Now which policy will pay the compensation for the driver or to his dependents? Only product liability and CGL. because this is a product defect. So product liability insurance will cover. Or CGL. CGL means commercial general liability. This liability has two components, public liability as well as product liability. So both these policies will pay and none other. Another example. Operations. Say guest slips on the wet floor in hotel and break his leg. Now he files the claim on the hotel owner. So under which policy the liability will be paid? Here product liability will not work. This is a loss or damage to the public. So the public liability and the public liability is also section of the commercial general liability. So the public liability and CGL only. Third example. Design defect construction. A building structure collapse. Which policy will pay it? Professional indemnity for engineers, because that is given to the reconstruction and other financial losses. So the design defect is covered under the professional indemnity policy. Similarly, leakage of poisonous gas, hazardous goods. Because of that, the death of people in surrounding happens. Which policy will pay it? Public Liability Insurance Act, Public Liability and CGA. Wrong treatment by a doctor. Which policy will pay it? Professional indemnity for doctors or professional indemnity for hospitals. Because wrong treatment by doctors lead to death of a patient. So the compensation will be paid under the respective policy only, because there are a number of policies. I give you an interesting example. After the Bhopal gas tragedy, the Public Liability Act 1991 came into effect. How? In Bhopal, that is the capital of Madhya Pradesh, on the night of 2nd December 1984, in a company called Union Carbide India Limited, that is pesticide plant. In this plant, methyl isocyanate gas leaked on the night of 2nd December. So because of the leakage of that poisonous gas, over 5 lakh people were exposed. Most of them died, and the remaining ones suffered the serious injuries and suffocations. Because this was the highly toxic substance made its way into the and around the small town located near the plant. And this is a real tragedy happened in India in the year 1984 at the Bhopal. Union Carbide India Limited is still there. Till then, the Public Liability Act was not there. After this incident only, the Public Liability Act was framed and came into the existence. So the base coverage of PLI Act provides immediate relief to the persons affected by accident occurring while handling any hazardous substance and for matters connected therewith or incidental thereto. So this is Public Liability Act. Who needs Public Liability Act? All those entities who are dealing in manufacturing, processing, treatment, packaging, storage, transportation of hazardous material, they all need this policy. Because the compensation could be in millions and billions. Now what does this Public Liability Act do? Here the limit of indemnity has to be selected. Say suppose A1 by is 1 is equal to 3. That means what? So where the AOA minimum has to be equal to paid up capital and maximum can be ₹50 crore, irrespective of paid up capital. Therefore, the upper limit of AOY is 150 crore. So all premises will be covered, transportation covered, deductibles are nil, occurrence but no application for relief shall be entertained unless it is made within the 5 years of occurrence of the accident. Premium is based on the turnover or paid up capital. Limit of indemnity and group of substances is selected according to risk occupancy, and the composition of premium would be risk premium plus environment relief fund equal to risk premium. As per legal provisions, the compensation payable as per the Public Liability Act is very small. That is the limit prevailing since its beginning. In case of death, 25,000 only. In case of injury, 12,500. In case of permanent total disability, 25,000. Property damage, 6,000. So these limits are very old. Now, under the public liability section, there are a number of policies. Non-industrial, industrial. So they are given as per the requirement. Whatever is required by the customer. Say public liability, non-industrial. To whom it can be given? Individuals, firms, offices, associations, housing society, hotels, clubs and restaurants, shops and malls, cinema houses, hospitals, educational institutions. They are all concerned with it. And premium is based on occupancy, limit of indemnity, AOI and AOY, and add-ons. Now I give you interesting examples of the public liability case. So how this liability is working. For example, you must have heard the practical example of Upahar cinema tragedy. On 13th June 1997, Upahar cinema, that is situated in Green Park, Delhi, in the 3 to 6 p.m. show, when the border movie was released in the cinema hall, so one of the worst fire tragedies happened. And in that fire tragedy, 59 people died due to suffocation. 103 were seriously injured in the resulting stampede. Stampede, Baghdad was it. So for that, 25 crore rupees compensation was given to the relatives and families of the victims. Because this happened in 1997, by that time the Public Liability Act was there. So the Upahar cinema owners were liable to. Another big tragedy in Jaipur, just behind our office, our corporate office. Fire in Jaipur terminal, Indian Oil Corporation. This fire continued for 11 days. 11 fatalities, means death took place. There were tankers filled with the petrol and diesels. There was blast in one tanker, and it was like bombshell. So that blast was so serious, the nearby tanker also suffered and came into the contact of fire. This process continued till all tankers burned. And this fire continued for 11 days. There was curfew in that area. No disaster management, no state government, no central government could control it. 11 people died. This was another case where the public liability policy came into action. For other purposes, you must have seen product liability policies given for defective products. And recently there was a case of unsafe lead in Maggie. So there was a complaint against the Maggie manufacturing company. It was proved that there is lead. Lead is mixed in the Maggies. It was proved. Court also accepted it. But there was no harsher decision to ban Maggie. Maggie is still available in the market. Some penalty was imposed. And they were directed to improve the quality. That's all. These are number of cases. Because of that, people suffered. And the product manufacturers had to pay the compensation. In case of tire, in case of tomato sauce, people died. Recently, the people of Calcutta must be knowing 89 people choked to death in a Kolkata hospital when smoke from fire in the basement spread through the central AC ducting. 89 people choked to death. So this kind of incidents are continuously taking place and the compensation is paid. That is the reason public liability insurance is must now for all big entities. So this is all about liability insurance. If you have any doubts, you can ask me the questions. Any questions? See, it depends upon the insurance company. They will not treat the previous policies as the insurance period. Because the insured may be having the policy with another company. So normally insurance companies are covering the liabilities which they have issued. But if it is agreed by the insurance company and they are ready to pay, in that case, the insurance period of that policy also considered. Normally in government companies they are considering it. Private companies are avoiding it. Private companies are, yes. Any other question from anyone? Liability insurance is a very interesting topic, and this is a very wide topic because number of policies are there. Oh, there are different terminology, which maybe this is your first lecture, so you are not aware with the liability insurance terminology. But when you are selling these policies, so you may be coming in contact with the brokers and customers dealing with all these products, so they are also exchanging the same words. After selling 1 or 2 or 3 policies, you will become familiar with this terminology. So have you received the test paper? Please confirm.